welcome to this explainer. We're diving straight into one of the most massive shakeups the logistics industry has seen in years, a move that fundamentally shapes how goods move across the country and impacts the broader supply chain we all rely on. Today, we're demystifying the anatomy of a newly independent titan, FedEx Freight. To really grasp the sheer magnitude of this business, just look at this number, $8.8 billion. That's their projected full-year 2026 revenue. This instantly establishes the immense scale we're dealing with here. We aren't talking about some scrappy startup trying to find its footing. We're looking at an established heavyweight charting a very bold new course.
And that perfectly frames our focus today. FedEx Freight is no longer just a division tucked inside a larger corporate structure. As of June 1st, it's a newly independent powerhouse with its own ticker, FDXF, and a very clear mission to absolutely dominate the less-than-truckload, or LTL, industry. So here's our route map for today's explainer. First, the new FedEx Freight. 2, one network, 2 services. 3, unmatched scale and density. 4, priorities through the spin. And 5, driving financial value. Let's get right into it.
Starting off with Section 1, the new FedEx Freight, and their strong finish to fiscal year 26.
Right before the big spinoff, they closed things out with a massive $2.4 billion in Q4 revenue, boasting a really solid 15.1% adjusted operating margin. But beyond just the finances, look at the ground-level execution. They hit a record-low DOT preventable accident rate, meaning their safety culture is completely locked in. On top of that, they secured their commercial foundation by hiring 100% of their dedicated LTL sales force, and they launched a brand-new custom-built pricing system.
This kind of momentum rolling forward, it's a highly deliberate strategy. They're laser-focused on revenue quality, meaning they want higher revenue per shipment rather than just chasing sheer volume. While the broader logistics space is seeing some softer market trends right now, FedEx Freight is overcoming that by prioritizing this quality, backed up by that newly dedicated sales force.
Moving on to Section 2, one network, 2 services. Let's look at the dual engine. This is where we get to the core of their competitive moat, how they actually move the freight. They give customers a choice between a priority offering and an economy offering, all running on one unified network. Priority is speed-focused. We're talking 1 to 3 days for transit, and it's actually about 40% faster than their nearest competitor. Pretty incredible, right? Then you have economy, which is value-focused at 3 to 6 days. Crucially, this economy volume helps spread out their daytime hub operations. The genius here is offering speed or value without needing 2 completely different sets of trucks or assets. And guess what? This strategy is totally validated by customer behavior. Nearly 50% of their customers use a mix of both priority and economy offerings. That proves there is immense demand for flexible mode shifting within a single network, giving clients ultimate flexibility.
Okay, Section 3, unmatched scale and density. Time to map the moat.
If you look at their physical footprint, they aren't just arbitrarily scattered around the map. They're strategically concentrated in the exact corridors where the most freight volume physically moves. It's a layout meticulously designed to capture 80% of the outbound industry volume right in the densest markets. The numbers backing that up are just staggering. Over 365 total locations, 26,000 service center doors, 30,000 motorized vehicles traversing the continent. That represents decades of intense capital investment. And the payoff? A physical infrastructure that lets them deliver approximately 90% of their LTL volume in 3 days or less. And customer loyalty matches that massive scale perfectly. Get this, roughly 90% of their revenue comes from customers who have been shipping with them for over 10 years. You literally don't see that kind of retention unless you're consistently delivering on your promises day after day. That kind of decade-long loyalty across incredibly demanding industries like healthcare, consumer goods, and industrial logistics, that's the fuel for a durable, long-term operation. They're a deeply integrated partner for over 140,000 active customers, providing reliable shipping across the continent. Which brings us to Section 4, priorities through the spin. How are they building the future? As a new public company, their future-proofing strategy is elegantly broken into 3 distinct steps. First, simplify.
That means streamlining their inherited tech stack and untangling their systems from their former parent company's transition agreements. Second, enable. This is all about modernizing their core IT infrastructure to deliver a better customer experience from day one. And third, enhance. Looking a bit further down the road, they plan to integrate artificial intelligence into their workflows and leverage key partnerships to really optimize performance at scale.
Finally, Section 5, driving financial value. Let's look at the bottom line.
Their capital allocation framework is incredibly disciplined. First, aggressively reduce outstanding debt, aiming for a gross leverage ratio of about 2.5 times within 12 months. Second, maximize the return of capital to shareholders through solid dividends and share repurchases. Third, maintain strict criteria to evaluate accretive M&A, basically profitable acquisition opportunities. And fourth, steadily invest in organic growth, keeping capital expenditures at around 5% of revenue over the medium term.
But here is the real financial punchline. The target? Converting over 90% of net income into free cash flow over the medium term. That translates to an incredibly powerful engine designed to generate over $1 billion annually in free cash flow, giving them tremendous operational agility. By making strategic tech investments and shedding those legacy transition costs, they've charted a clear path to expand their margins. They're targeting an increase from a 12.6% adjusted operating margin in fiscal year 26, all the way up to a medium-term target of approximately 15%. So if you're closely following this Titan's journey, mark your calendars. By mid-August 2026, look for their fiscal year 26 10K filing to see the financials on a carve-out basis. Then tune into their inaugural FDXF earnings call in late October to see exactly how these ambitious strategies are playing out live.
That brings us to our final thought. Armed with this incredibly wide physical moat, a unique dual-service network, deeply ingrained customer loyalty, and a billion-dollar cash flow engine, how drastically will FedEx Freight rewrite the rules of the LTL industry as an independent titan? It's going to be a fascinating journey to watch unfold. Thanks for joining this explainer.